Hello and welcome to the AIM Summit webinar on disruption in traditional wealth and discretionary management. I'm your moderator, Zachary Ferrario. I'm the CEO and founder at Dalma Capital. We have people participating from over 30 countries today. Amongst you are institutional investors, family offices, high net worth individuals, and leaders across the financial services industry. Please feel free to submit your questions on the Q&A dialogue. You'll see at the bottom of your screen a Q&A button. We're going to be taking questions. Feel free to submit questions throughout the session. Most of them will be taken at the end. If you're joining us on YouTube, please like this video and subscribe to our YouTube channel now. I'm so glad to be introducing our webinar partner today, Saxo Bank, an industry-leading provider in multi-asset trading and investment platforms. Saxo Bank constantly innovates to improve the Saxo experience and empower people to invest in global financial markets, ultimately enabling them to fulfill their financial aspirations. It's such a pleasure to introduce a colleague, a friend, someone who I've come to respect and admire in the industry, working at Saxo Bank. That is Wright. I can personally describe him as thought-provoking, passionate, and knowledgeable about the and certainly an electronic trading industry veteran who is now responsible for building relationships with banks and other financial institutions to use or white label Saxo's platform with a focus on banking as a service, or BaaS, multi-asset execution, Robo advisory, digital channels, and prime brokerage solutions. We're so glad to have him as a moderator for this session and for part two of our series of webinars around the evolution of wealth and asset management. Nicholas, such a pleasure to have you today, and thank you so much for joining us.
Awesome, thanks, Zach. So welcome everybody, and I'm truly excited about the guests that we have today speaking, and I think we're going to have a real thought-provoking and hopefully controversial discussion. Before I introduce our speakers, I thought I'd set the scene a little bit. It's been well documented that individual investors have played a massively significant role in markets during 2020, accounting for well over 20% of US equity volumes. And in fact, in all asset classes, they've been up on participation. All online brokers, all Robo platforms have seen huge growth in AUM, account openings and volumes. Indeed, at Saxo ourselves, we've opened nearly 240,000 new direct accounts in 2020, and we see the pace actually picking up in Q1 2021. Clearly, the watershed moment was the crash in February and March, or the market rout, and then the volatility resulting from that, and then the central bank stimulated market recovery. However, I can definitely say that there have been catalysts building for the past decade that I believe are leading to this huge change in how investors want to manage their wealth. Some of these catalysts being, tech, big data, AI, changing regulation, changing demographics, social behavior. There's a rampant demand for digitalization these days. Lower cost products like ETFs and beta strategies, fee compression, and of course the increased participation of fintechs, bringing competition to the market. I've certainly heard quotes from global banks out there. One in particular came from the head of wealth at Citi, who was quoted in saying, "It's urgent. We know that if we don't get there first, we'll be the ones disrupted and killed," with regards to the digitalization of his wealth platform. So I'm really excited to explore today whether this online trading and robo wealth growth can continue, and what it's doing to the traditional wealth management space. So with that, I'd love to introduce our panel, esteemed panel. We have Frederic de Melker. He is basically Managing Director of Personal Banking at Wright Bank, and really looking forward to hearing your comments, Fred. We also have Mehdi Fitzgerald, who is the CEO of Finamaze, which is a new startup robo asset manager. And we have Michele Ferrario, who is the co-founder and chief executive of Stashaway which is the #1 digital wealth manager in Southeast Asia. So a really great mix of panelists. I'd like to kick off, if I may, with Michele. Michele, in the last 3 years, investors using digital advisors grew 5.5 times, reaching 70.5 million people, and it's expected to grow to 147 million by 2023. So, as you know, the co-founder of one of the leading digital wealth managers in Asia, and obviously spreading across other regions, you know, what do you put this down to? Why is there an unprecedented demand for change in the wealth space? And if you can tell me some of the advantages that you get from a digital wealth manager versus a traditional.
Yeah, so first of all, thank you for having me, and thank you for the question. As you mentioned, just to give you a perspective of where my point of view may come from, I co-founded a company called Stashaway, and we are a digital wealth platform managing a bit more than $1 billion between Southeast Asia and the Middle East. Now, to your question, we've obviously built the company on exactly the type of trend that you described. So we built the company because we thought there was an opportunity to tap into this trend. And I think there are kind of two ways or two main areas of inputs to this trend. On one side, and you described them earlier, on one side, there is a bunch of enablers. There is a widespread technology. Everybody has, you know, a computer in their pocket called a phone, but it's really a computer. You have ETFs becoming, you know, very available and giving access to a variety of asset classes. Fee compression on the security selection side, again, through ETFs. So there is a number of enablers on one side. And maybe very importantly, maybe not talked about enough, and not only people now have a computer in their pocket, but are very familiar with it. So they use it for many, many, many different things. And they trust it. Like, it's not like 10 years ago where the phone was something you would use to make a phone call, type a message, maybe emails, maybe a video call at a certain point. Now it's much more than that. So that's one set of enablers that made what you just described possible. And there is a second group of factors. And I think those factors are particularly relevant in Southeast Asia, in the Middle East, and in kind of other areas of the world, maybe less relevant in the US and Europe. And that's simply our conviction. I'll give you my point of view, that the financial services industry have been very inward focused over the last couple of decades in these regions. And rather than putting the client in the center and really improving the service, reducing fees, giving clients real access to global asset classes, bringing personalization to the table, they're actually trying to milk the cow. And so, you know, in Singapore, and I heard in Dubai, similar, if you are a affluent client with a couple of $1 million in assets and you go to your bank, to your premium bank, what you will get pitched is buy a mutual fund, a unit trust with a 2.5% entry fee, or buy an insurance-linked policy with maybe 2.5%, 3% fees that you don't see, that are actually hidden in various pockets of the product, or structure notes with very uneven risk-reward structures. So I think the combination of the enablers I mentioned earlier and a very large gap between what the industry offers today and what can be offered leads to new players or all players having the opportunity to improve customer service and client satisfaction by 10x. And that's what I think happened over the last 2-3 years. And that's why a lot of investors have now flocked to invest a bit more.
Great answer, and I'll definitely come back on some of those points, but I think it'd be great to give the traditional bank, Fred, in your opinion, okay, any response to what Michele has said, number one, and number two, you know, what given you are working at a traditional bank, let's call it, RAK Bank, obviously top 10 bank here in the UAE, what, from a wealth perspective, you know, what's the right mix for a bank to be able to tap into its customer base and obviously different client segments? I'm sure that it's a different scenario for you than it is for a fintech starting up with, no customers?
Yes. Yeah. Thank you. Also from my side for being here and to share my thoughts with you. Well, from a wealth management and wealth point of view, I think there are two very different things here, right? We have wealth as a product, and that is what banks were doing so far. And then indeed, I fully agree that you come up in a situation like entrance fees and then hidden fees, because banks were from the 90s simply saying like, okay, our NII is coming down, we need to have fees from somewhere. And then of course, wealth management business for retail banks was super exciting, right? But that is wealth as a product. If you go and see, if you went to a bank and then you saw an RM, was that the real relationship manager? Was he a real advisor, or was he a salesperson, right? And that is also why I think those days a lot of central banks started inventing, yeah, but listen, if you want to do advice, it is something more than simply selling a product, right? If we look at the model today, it is absolutely ripe for disruption, and it is disrupted, right? Because at the end of the day, it is only about one thing: killing that middleman. If you talk about wealth as a product, it is simply about killing that middleman. The middleman is too expensive. He's asking entrance fees, he's asking extra fees here, extra fees there. So, which means, for instance, if an average market would give you 5-6% per year, a conservative equity fund would give you like 5-6%, and then the bank can churn your portfolio every 2-3 years, taking 3% away. Well, then at the end, if you would make that calculation, your equity risk would be reduced to a bond return, right? So too expensive. Secondly, retail customers today are also demanding access to products that today go to high net worth or institutional investors, right? It is, and I think if we look at the trend, certainly last year, you see a lot of customers who are purely in the retail space are now moving into that kind of products. They want to know everything about private equity. They think themselves about ETFs. If you go back 10 years, nobody was talking about it. You went to the bank and the bank was giving you that product. The third thing is, of course, regulators, right? Regulators are chasing banks, right, to become more transparent in their pricing. And if they talk about advice and they talk about helping the customer building his wealth, also to bring that certain level of expertise, right? Now, digital is, of course, and not only for a fintech as a fintech initiative, but also for banks, it's absolutely the way out to leave the past for what it is and to transform that business from the old-fashioned product, wealth as a product, into wealth as a service. And I think this is where bank can do the right transition. If bank lack that transition, for sure, within no time, they will not be part of this market anymore.
So it's all about moving away from being product driven to service driven, and I guess becoming more customer centric.
Yeah, absolutely.
Interesting. Yeah. Mehdi, you're building, or you have built and started now a new Robo asset manager called Find Amaze. I'd like your opinion. We've seen Robos. I think we're up to around 300 now globally. Around, I'm sure Michele can give me the correct figures here, but we're up to around $1 trillion, I think, under management with Robos. So what is the evolution of the Robo? Robos have been around now since what? The last financial crisis. We've been in a period where it's been fairly beneficial to be long only. You just needed to be long only. There's plenty of ETFs around. And many Robos have literally just given access to a bunch of ETFs, to be long only. Do you see that still remaining? Do you see that actually asset allocation and strategies is where the battle is going to be fought with the new era of robos?
Yes, you are completely right. I think that the average customers for the online investment, may it be at the brokerage level or at the robo advisor level, is looking for more than just having access to the market. And whilst the robo advisors or some of the broker online have been very good in attracting some market segment to this kind of investment, today this same segment is asking for more. So as you mentioned, the ability of a robust manager to understand its client deeply, understand his risk profile throughout the cycles of the financial market will be a key element in order to give the right portfolio and to calibrate it according to each customer. What we have seen today is that most of the asset management players, may they be traditional or robo, they tend to divide their customers according to the risk profile into 4, 5, 6, 7, 8 categories perhaps. But I think, and this is why we created Finamaze, we think that mankind is much more diverse, and the type of risk that each client is willing to take goes beyond the eight mark. What we have developed is a system that is multidimensional, takes into account a full behavioral dimensions, wealth, experience, objectives also, and try to make it to granular to the point where we can indeed create different risk management tools, but more than 4,000. That's on the one hand. On the other hand, I believe also that the customers today are not only willing to invest in the markets, they are becoming more educated. Some of them also tasted the zero management or the zero brokerage fees of some of the online brokers, and now they have got some views, they've got some opinions, and when they want to implement them, they have the choice by either going into an online broker who will give them thousands of securities. I mean, we talked earlier on about ETF. Try to find an ETF that follows the S&P 500. You have, if not dozens, you have at least 5 or 10 who are very large, and it's very difficult actually to make the choice between these ETFs, and these ETFs are not perhaps suitable to every person. So what I think that the average customer is looking for is to get control of his money, to get control of investment, but he has got the time and the bandwidth to only do it at the strategic level. What you don't want to do is do it at the tactical level. And what we Finamaze try to offer, and this is the feedback that we are getting from our first clients, is that what they like about us is that we allow them to choose in which segment of the market, which team of the market they want to invest, and on the top of that, add on it an AI that will allow them to calibrate the investment of their choice according to their risk profile. And I think this is what will basically lead us all to basically compete more and better and bring in the robo advisor, I would say, 2.0.
Interesting. Guys, I want to open the next point up, and it's bringing in a poll that we did before this actual webinar, where our viewers were polled on whether they thought they could do a better job using an online broker, performance-wise, or whether an asset manager or an advisor could do a better job. And actually, believe it or not, it came out 56% saying they thought they could do personally a better job than their advisor. So that's quite startling, albeit it does sort of play into the volumes and the pickup in adoption of online brokerages. So what are your opinions on that? Why does that exist? Why do individuals actually believe they can do better job than professionals? Any thoughts?
If I can voice over, I don't have data for this. This is going to be just my point of view. I think on one side, because a lot of people have the experience that in the last decade, their advisors, or 2 decades, their advisors have been underperforming what they've seen the markets doing. I mean, it's no secret that active management has underperformed passive management over the last couple of decades. And therefore, if people like the end clients have been looking at the data, they probably have realized that that's the case. And so when you compare with, what the stock market has done and what maybe me as a client, have done, you realize that I've done less than the number I see on the screen. Now, sometimes risk gets lost into this logic. So sometimes people compare, my 50-50 performance versus the S&P 500 performance. So that actually makes that difference even more extreme. But they realize that if difference will probably be there nevertheless, right? Sorry, I inadvertently muted myself.
Yes.
Yeah, sorry. So that's one area. And the second area is that we are in the era of everyone is an expert on everything. There is everybody's a doctor online, everybody's an investor, everybody is a soccer coach. I'm Italian, so that's particularly true in Italy. And everybody becomes an investor and a financial advisor. And this is part of you find information. It's also fun, right? You go on Reddit and you find some hints. It's part of it's playful. And so I think that's natural. So I think the responsibility of the industry is to bring this back to what makes sense, which is trying to help people improve their performance, because it is true that on average, the end client have seen a very small part of the value created by the markets globally over the last 2-3 decades. So actually giving to people a more significant part of that upside by making the industry smarter and more efficient, I think it's part of our what we need to do. I also believe, and this is maybe a bit more controversial, I also believe that we have the responsibility to guide people as well, because as I don't think that everybody's a doctor, I also don't think that everybody's an investor and has all the tools required to actually build up an actual portfolio that makes sense given their timeline, the risk level, etc. But I think it's on us as a financial services industry to actually change that perception and build the right type of advice. I think one of the reasons why Stashaway has been successful over the last 4 years, and we are a young company, so we're still, as I mentioned, we manage $1 billion, which is not a gigantic amount of money. We're still early, but one of the reasons why we grew quite fast, and we're still growing quite fast, is that people's perception, our clients' perception, is that we are actually putting their interest above everything else, which is true. And that comes up in great returns. People with high risk have seen 17% returns year on year, per annum. People with low risk have seen 5% returns per annum. Those are numbers that they think are comparable to what you read on the papers. And so people start believing in the fact that a platform actually helps them giving their fair share of the upside.
Excellent. Fred, okay, so Michele has, sort of concurred that there has been maybe a belief and a breakdown, I guess, in the wealth business to lead individuals to believing that they can do better themselves. Could that be in the past? I think you've touched on it, that the industry was very, product specific, suitability wasn't really being done correctly. I'd like to sort of get your opinions on the fact that now banks in particular, and certainly firms like Stashaway, you have tremendous amount of data now available to you. Do you see that the future is to use this data much more smartly in order to be more helpful and more innovative with the portfolio creation and the product choice for customers? Do you think is this a key area, or what do you think about that?
Yeah, well, of course. I mean, since the existence of banks, we have more data about you than Facebook has, right? I know your salary, I know what card you use, my credit card, so I know exactly that you go to that restaurant and you pay for it, and not that you're making a picture in front of a fancy restaurant and you pretend that you were eating there, right? So for sure, banks have all that data, and I think one thing that banks are absolutely underperforming, it is in that data management. They still are having the same platforms, and they keep saying, yeah, but I have my legacy systems. But simply, The problem for banks is today, if we talk about data, is simply attracting the right talent to work on it, right? I mean, today, a data analyst who knows exactly how to transform such a pile of data into a well-organized data pool or data warehouse are people who don't want to work for banks today, right? So that is absolutely an issue that we're seeing every day. Talent is not really interested to go to a traditional bank. That's one thing. We were talking about customer thinking they can do better. Well, I started as an advisor in wealth management in '95, and since that time, it was always the same story, right? If a product is doing very well or a portfolio is doing very well, then the customer says, yeah, well, I took the decision, I signed for it. And if the portfolio is going less well or not in line with what the customer expects, he will blame his advisor. And that will not change, right? I think it's a very good example about people going to the Google doctor, or people going to doing everything themselves, and they think they're a doctor. Yeah, well, till your wives tell you, in my case, like, okay, now stop the crap, you're not feeling well, you're going to see that doctor. So putting things back into perspective, traditional banks, right, they need to move more into, like I said, wealth management is a service, right? They still have the position and the means to make that very successful. And I don't think that robo-advisors or platforms should be, per definition, a competition there. I think it's very clear that the initiatives like Michele's is showing the way forward. And yeah, again, some banks will pick that up and be smart and use all these elements and puzzle pieces they have to renew themselves. Unfortunately, the majority will still be very late in the game. So I think, yeah, for strong robo-advisors who crack that code, and certainly based on data, I think they will have a very, very strong future. Excellent.
Coming back to fintechs, Mehdi or Michele. So I think, where do you see the role with AI and big data? I mean, obviously we know the banks have got already a captivated client base, and that's a challenge for startup and certainly younger firms to get that. But where do you see the product offering going? And is this a key area in being able to provide, more customization and more service as an advisory? I mean, is the client just looking for an investment portfolio, or is he looking for more information and more help? And is this where you're heading, or is it just primarily focused on his investment portfolio? And when I mean more services, obviously I mean in terms of wealth planning, in terms of tax, in terms of every aspect of his life.
Yeah, so maybe from our perspective, we definitely look at our platform as a platform that goes beyond the pure investment portion. So it's we define ourselves as a wealth management platform, and so we look at, we started from investing. Our core product is an investing product, but we are looking at how to expand our range of services for clients. And I strongly believe in what Frederic mentioned earlier, that we need to think about wealth management as a service rather than as a product. And that's the way we think about it. In terms of how data or AI plays into it, I'm not a believer in the use of AI for investment management purposes, especially if you're taking very long-term views. Like, we help our clients build retirement portfolios. I don't think that you need AI to optimize your portfolios. I know that some people in the robo-advisory industry talk a lot about machine learning and AI. I actually don't think it helps in actually creating superior returns over time. And actually, to be frank, I don't think there is a lot of players out there that actually use machine learning or AI, rather using it more as a marketing instrument. Where I think that big data and all the technologies that go with it, machine learning, AI, and what else actually can play a big role is in personalization of the experience. And therefore, going back to Nicholas, your question on, do you go into, helping on financial planning, for instance? I think there is actually a lot to be done with data to personalize that conversation through the platform. And obviously on the marketing side, so on CRM, for instance, on kind of trying, which also goes hand in hand with personalization, trying to show the right product to the right client at the right time and using data to make sure that equation actually works. So we, as Stashaway, we are, our investment framework is very sophisticated, but does not use machine learning. And we don't think we're going to go there. Where we actually try to use data technology is on the personalization side and on everything that goes with it.
Excellent. Mehdi?
So I don't think that the perception of AI as being you just press a button and you let the AI do everything is the right one. For me, AI is basically a powerful tool that we today have that allows us to treat a large amount of data and that allow the human being to take better decisions. So as an asset manager, thanks to AI and thanks to the information that we can get from our clients, and not from only one, but from a large number of clients, and not only from one client only at the time of his registers, but throughout the life cycle of his investment, we get to know better and better the client. And what would happen here is that instead of having a human relationship manager who will keep on chatting with the customer in order to understand what are his real needs, we are doing it in a more clever way, in a more sustainable way, and I would say even in a faster way, because we are using AI. So that will be on the one hand. And on the other hand, and this is basically to repeat what Michele said, a lot of people actually do enjoy investing in the markets and taking decisions by themselves. And indeed, what they're interested is on their performance. But when you take this performance and put it and you divide it by the volatility of their portfolio, then it becomes another story. When we are in a unidirectional markets, it's quite easy to make money. It's quite easy to think that you are the right expert because whatever you touch ends up being gold, right? But in reality, the markets are not just a one-way direction. They are wavy. And what will be good is, for example, to allow clients to implement their views, but to tell them, you know what, we understand where you want to invest. We understand how you behave because you have been with us for such a long time that you understand what are the risks that you like, how do you behave actually, or how do you want to behave if the performance of your portfolio is above your expectations or is under your worst case scenario. We get to understand the client's risk, and what we tell him is that just take the strategic decisions and let the machine, it is made for that, let the machine do the heavy lifting, let the machine read the news, let the machine detect the sentiment, and let the machine ultimately play within the boundaries that you investor, that you human being, allow it to express itself. So does it bring superior performance? The simple answer is yes, because it shields the portfolio from the different emotions. Some people, we as human beings, especially when we invest, are between the fear and greed. And these are two emotions that are not easy to tame. And even professional investors, traders, and so on, may go beyond their limits because they are taken by the way of either an excess fear or an excess greed. What the machine does, because it is made how it is made, it basically tries to take, I wouldn't say rational decisions, but I would say informed decisions. And this ultimately, it basically calms down the volatility of the portfolios and ultimately might not achieve always better performance, but what is for sure is achieve the best performance given a certain level of risk. And ultimately, this is what I think the AI could play a role in the future of asset management by allowing people to give guidelines, and letting the AI take these tactical decisions.
Great. So we have one pro AI, one less pro AI. Fred?
The banker is always the one in the middle. So, well, first of all, if you talk about investing and wealth, right, the action is always very rational, right? I'm going to invest in this particular asset class or this commodity or whatever for all these good reasons, right? And I will decide that, and it can be based on what I'm getting from an advisor and I believe what this person is saying. It can be that I am on a YouTube and or on a new, I see a news feed and I see a specialist talking, right? And I will of course always try to go with somebody who's already sharing my opinion, right? If I'm absolutely against stepping in gold today, right, I will automatically, and there I agree on the emotional side, I will automatically go and listen to people who are, or to messages that are, don't do gold today, than the ones that say, no, maybe you should think about it. So I think there indeed AI can be more unbiased in one way or another. But the reaction is always irrational, right? And this is what, okay, I see the outcome of my investment, and if it is very, very, very good, then I will invest more without even thinking, right? If it is less than what I thought, then I will start blaming somebody else, like I said. So for me, simply putting everything into, okay, AI can solve it, I don't think so. While I think it is having absolutely a place in, and like what Magdi is saying, taking over a lot of tasks that human beings maybe cannot do because it's too intensive for us.
Yeah.
But talking about the framework of AI, building portfolios, advising portfolios, well, honestly, we're still day one, right? I mean, what happened so far? We are in this journey for a few years now. I mean, we saw what happened last year, a pandemic. Yeah, but if now a pandemic will become part of all our models, we know that the pandemic is there every 100 years, so it will hopefully be only once for me, right? At the other hand, if we would have a financial crisis like we had in 2007, 2008, where everything became uncertain, and I was there at that time, when you see a Lehman Brothers failing, right? I mean, how is an AI going to react to that? Okay, we now can do the back testings and whatever because we know what happened after that, right? A huge bull market.
Right,
but,
can I jump in here, because you bring in actually a point that I've been thinking about for some time. So the current market, we had billions, trillions flow in through ETFs. And obviously we know that this is central bank stimulated market recovery, whatever. But I'm quite interested, given the scenario you just said, you know, guys, what happens if we see a reversal in this, you know, in this bullish trend? You know, the retail stampede and the passive versus active, you know, the amount of money that's gone into passive ETFs. What do you think?
Yeah.
Is that a worry? Yeah. Are you concerned about that?
I think the fact is there are a lot of retail players today in the markets, especially in the ETFs. Actually, it increases the type of volatility that the market used to be, because a lot of decisions are made at the micro level of each individual, and basically they're pumped up into becoming a large bubble. And when the bubble bursts, the effect will be even stronger if things go down. Yes, you are completely right. I mean, the fact that you have a lot of retailers in the market actually increases overall the volatilities, and you can of course see it in the past couple of years. You can mathematically detect the increased volatility each time that the retail players come in this space. Now, to come back to the remark of Frederic, yes, I agree with you. The strategic decisions should be, and today we don't have the AI is not at the level at which it can take strategic decisions on how you build a portfolio on what are the right assets. There has to be a human being on the top of that, a human being who can either be an asset manager or a collaboration between the asset manager and the investor by himself. But when it comes to the tactical decision, detecting the strong movements, detecting an increase of volatility, detecting, for example, let me be a little bit technical here, that the more and more assets are being correlated. These are all good signs of something big that is happening. And what the AI can do is that instead of just letting the human being make a decision, it can detect the market momentum. It can also detect the market sentiment, how the news are being read, how often, what kind of news have got a pessimistic tone over the news that have got optimistic tone. All this will give very strong indication in a much faster manner and a more accurate manner than any human being can do by himself. So the result of it, of which is passive investment, you just follow the market. Market goes up, you do well, the market goes down, you fall down. But if you add to it some tactical decision that can be taken by AI or by algorithms, then you can shield yourself from this excess volatility that the market can be put in a lot of portfolios without even the knowledge of the investors. I wouldn't know if Michele would agree on that, but I believe that their experience that you had in 2020, February, March can potentially give us some lights, right?
Yeah, look, I can actually, let me also clarify my views on AI, because maybe I wasn't clear earlier. So what we do at StashAway from an asset management, investment management perspective, it's fully algorithmic. Meaning, when I say that I don't believe in using AI, machine learning, or a kind of big data technology to optimize portfolio, I'm not saying that I believe in having a guru waking up in the morning and deciding where to invest. What I mean is that I don't think you need that level, that type of technology. I think you can be algorithmic and systematic in nature, and I think you should be, to take away investor biases and human biases like you guys discussed earlier, but you don't need AI and machine learning to optimize a portfolio if that portfolio has a goal of returning or giving you returns over the long term. If your strategy is trading in and out of the market very quickly, then I agree with you that AI and machine learning are the technology that will enable you to manage enough data to actually make quick decisions. You can check on Twitter what are what are people tweeting about, and then make a quick trade. But that's not what we believe in. What we believe in is proper asset allocation, avoid security selection, think long term, and build very reliable portfolios. To make this point, look, what we, last year our portfolio has done incredibly well, and we've done very well throughout the crisis. And the reality is that the right thing to do, and I know another player, I'm not going to name them, but there is another player I know that actually uses volatility measures to make trades. And what they end up happening is that during the month of March 2020, they started reducing their equity positions and investing in money market funds because there was a lot of volatility, and they did it as the market was going down. And then the market, then the Fed came in, the market, jumped up very quickly, and they lost completely the momentum because they had 60% of the portfolio money market funds. So the reality is that trusting too much the historical reading or the last day reading without actually putting an intelligence on top actually can lead to disastrous results.
Okay, we're getting really an abundance of questions coming in, and so I'm conscious that there's a lot of interest from the audience. I'm going to say that I think we covered AI and machine learning, and I think in general it seems to me that it will play, and especially big data will play an ongoing and possibly bigger role in the future. Moving to quite an interesting subject. So one of the things that we can all in the industry acknowledge is fee compression and commission compression. It just heated up in 2019, where US brokers came out saying we're executing commission free. I think this was this was well publicized. So my question to you guys, and I open this up, it also goes with giving service, because what I believe in the wealth space, and please correct me if I'm wrong, Michele, from your perspective, or Mehdi, but I'm sure Fred will concur that I don't think we are yet at a point where the baby boomers and the Generation X's are ready to go to a complete robo. Okay, and certainly as the sums get bigger, the less inclined you are to give money without a human being somewhere along the line. So I've got, it's a double-edged question here. One, are we at the point where it's full robo, full low touch? Are we at a hybrid point? But if we are at a hybrid point or needing high touch, how do we do that and make money? And how do we charge fees given the compression that we're seeing in the competition for fees?
That's true.
So your thoughts on fees versus service versus low touch, hybrid or full touch?
Sure. Well, if I can quickly answer to this, yes, usually when you don't pay something for a service, it means that you are the product. And actually, the firms that offer zero commissions of trading, what they do is that they sell the client's volume to much bigger market makers. So nothing is really free, and I don't believe that any customer of one of these platforms believes that he is really making, that the company is making $0 out of the volume that they are bringing in. So you always pay. The question is what you get in return. So indeed, if you are just having a platform where you press the button, it executes, you basically just gonna pay the electricity and a couple of machines that run the system. But if you want to have quality, and I agree with what Michele and Frederic said earlier, we are not today at a point where an AI or algorithms can fully 100% leave any human touch out of the asset management business. There has to be some. But what we can do, and this is related to the fee compression, is that we can use this power. We can harvest the AI in order basically to make it do the things that are costly in time, that are costly in terms of money, that does not bring a real value to the customers, and we make it do that part. But whatever is strategic, we keep it to the human being. And at the end of the day, it's a volume play. If you have resources, human resources that take strategic decisions and manages a big enough size of volumes, then mechanically speaking, you will be able to reduce the fees. And this is why I think we can use AI and algorithms in order to reduce the fees by letting the human beings do what they are best at and letting the machine do whatever it is best at.
Thank you. Fred?
Yeah, well, I think for sure it's a hybrid model, but it also depends a little bit on the customer segment we're talking about. If for instance, I'm a customer, I'm a mass affluent customer, and I have a total wealth of $50,000 or $100,000, I mean, it will be totally different than a customer who's having a couple of millions, right? I mean, if we see where Robo is very popular, and you talk about millennials and younger population, I mean, but then you also talk about the people with less wealth, right? I mean, if you and we say, yeah, okay, the boomers, whatever, no, still the majority of the wealth is with that older generation, right? And they're learning from the younger generation now, and they're trying to step in and say, yeah, well, why would I pay for my mutual funds 1, 2, 3? And okay, let's not talk about UAE because it's less regulated in that sense, but I don't want to pay 1-2% if I can simply push the button and I get the same fund somewhere else. So I will talk to my banker or advisor, and he says, okay, you need to buy that product. And you say, okay, I'll think about it, and you simply goes for best and cheapest execution, right? So if you look from a segmented situation, then I think the first level, yeah, well, using AI, for instance, yeah, you will certainly go in a kind of a Netflix model, right? This is who you are, this is what you want, and then I give you the products that fit you the best. And it will never be 100%, this will be 95, 93, 80, So that is certainly the first level. I think the second level, and that is for me very interesting, we were just talking about, my neighbor is saying, or this guy is saying that this is good to do, so I will do it. I think these peer portfolios that you now have on a lot of robo advisors, where you see, okay, this person is today saying something going into crypto, and it's a crypto fund. Okay, I'm simply going to copy paste because this guy is going good returns. It has nothing to do with AI. It's simply copy pasting what somebody else is doing. So I think that is absolutely the next level. I think the third level is then getting the unbiased information and the specialist advice. And the higher you go in these levels, the more people are willing to pay for that. Because let's be honest, there is a lot of information, but bringing unbiased information, bringing the right sentiments, like what Magdi was saying, I mean, that costs money, right? And people are willing to pay for it. So it should be priced in the right way. And then you have the highest level, and that goes more into high net worth, where I think that human interaction is still very important from that relationship point of view, because trust in a person is still very strong. And I don't see at that high level that will go away. If we talk about our money, or we talk about any other things we like, I mean, with money, our reaction is totally different than with other things, right?
Understood.
And that is what I think that these four levels will be important. So hybrid.
They're very much segmented by the customer type. Michele?
Yeah, can I add something there? So from what we see, so around 20% of our assets come from accredited investor or high net worth individuals. And so we have people with several $1 million with us. And the way we think about it is that, and also we have people with $50 with us. So we have kind of the full range. So I disagree when you guys say that a purely or a mainly digital platform only caters to the needs of the mass market. And the reason I disagree with that is that I see it in our numbers, in our interaction from our clients, and there is a lot of high net worth individuals that actually are super happy not to talk to anybody for things where they don't think there is any added value. So to make this point earlier, a lot of high net worth individuals want computers to do what computers are good at, and people to do what people are good at. And so our interpretation of that from a business perspective is that we offer what we think the computers do best, which is the investment management through algorithmic investment management, and 24/7 access to information, et cetera. We offer that out of the box, kind of with a digital perspective. And then we offer access to human beings, and to everybody, including mass market. You can call the Stashaway phone line, and we pick up the phone in 8 seconds. So we actually bump up the level of service quite a lot. You can WhatsApp chat with our customer support, and this is human beings, is not a bot. And this is true for people that have even $50 with us, or even $0 with us, people that have an opening. To high net worth individuals, we actually have wealth advisors whose job, though, is not to sell stuff. So their compensation structure is not, if you sell a unit trust, you get more bonus. Their compensation structure is based on inputs, not on outputs. It's based on what they do. And their incentive is about helping people understand how Stashaway fits into their financial life. And so that's how we kind of cater to the higher net worth individuals and solve partially, I guess, what you feel is, or you mentioned being the need for human touch. Now, maybe to close on this, I think one of the argument that I heard many times is that mass people will be happy with a fully digital platform. Wealthy people will not be happy with a full digital platform. They want a relationship. I actually don't think that wealth is the biggest driver of this. I think digital propensity is the biggest driver. We can proxy it as age, even if it's not perfect. So if you have 2 30 years old, one is very wealthy, one is not wealthy, and 2 65 years old, one is very wealthy, one is not very wealthy. The 2 30 years old will be Stashaway customers, even if one of them is very wealthy. The 2 65 years old will probably not be Stashaway customers, even if one is not wealthy. So digital propensity is much more of a factor than actual wealth. I believe in choosing the type of interaction mode.
To jump in there, Michele. Oh, go on, Fred, please.
So I didn't want to say that a high net worth customer will not go for a platform, right?
Yeah.
But the question is, if that high net worth individual is, for instance, having $10 million with you, what is the share of wallet, right? If somebody's having 100 million and he said, listen, for that specific service, I don't need to pay I don't need to speak to somebody because I know exactly what I'm doing and I want to invest in these specific investments, then okay, then it's simply best execution. And for me, best execution, it's through that platform that I trust, right? But I fully agree with you. It is not only the segmentation in wealth, it is the segmentation in age, like what you bring up.
Yeah.
It's also segmentation, experience, and knowledge that plays a big role. But I think, we both agree that it is customer first, then it is digital first, right? And then it is certainly needed also that element of human interface.
No, I agree. Maybe, I agree with you. And to add on this, I think what then becomes, I think, very interesting for private banks is the offerings that are impossible to, that needs absolute customization. Legacy planning. Legacy planning is very difficult to do at the high level, to do it in a non-customized way. And so that's where I think the private bankers as human beings need to specialize on. So I think private bankers over time will need to learn, those that haven't learned yet, they need to kind of sharpen their skills at what cannot be done by a machine. And that, I don't think it's asset allocation. I think it's more legacy planning, tax planning, hand-holding.
To move on, because we've got time and so many questions, but I think one last thread on that story, obviously, and I think we're all in agreement that there are a number of factors that will determine how much service you need, but I think we've uncovered many of those factors, being age and amount of investment, etc. But I mean, we have got the biggest transference or inheritance ever in humankind over the next 20 years, which is going to be inherited by a digital native market. So if we're not there today, which it seems we're not, do you think we will be there in 10 years' time?
I don't think we will have any choice. I mean, it's either as managers will be able to adapt and use all this power that is given to us through AI or digital means, or we will simply be part of the past. And definitely, you're right. I mean, finance management, like any other sector of life, is being challenged today by the high calculation power of the technology, may it be health tech, edu tech, etc. And there's only one way. There's only one future, is to realize and understand what technology is good at and how it can help us do better our job. Again, AI is not an objective, it is a tool. It is a powerful tool. And if put in the right hands, it can deliver better results at a fraction of the cost and a fraction of the time that is required.
Okay, great. So moving on to some of the questions that are streaming through at the moment. And here's one I think is very relevant given our speaking panel. Do you see consolidation of fintech within traditional banks and wealth management platforms in the near future to organize supply side or wealth management services? We've got a bank and we've got two Robos.
I think my point of view is that if you fast forward 5 to 10 years, you're going to have a mixed situation. You're going to have certain banks that will have done very well, that will have improved their digital service, and they would have thrived. You would have certain banks that would have potentially purchased some of the new players and therefore digitized through acquisitions. And you would have some of the new players that will be staying independent and maybe build kind of strong businesses by staying independent. I don't think there's one rule. I think that what's going to happen is definitely that there's going to be significant digitization in the space. But I think the type of outcomes will be very broad. They're going to have different types of winners.
And for the banking industry, I can give you some numbers that Accenture came up with. So they did a survey in 22 countries, and in these 22 countries, they surveyed the 160 biggest banks. And they found out that 50% of these banks have today no real digital plan. It simply was not a plan. 38% of them were doing a lot of stuff, but if you were asking, okay, what is your strategy? They were not coming up with a coherent story. Only 12% was very sharp and said, okay, this is what we're doing and how we're doing it, right? So that is automatically an answer to your question. Yeah, consolidation will happen because you only have a few banks today who are really serious about the future. And okay, I can talk about this for hours, but one main aspect is, yeah, but you know, I have this current business now at the fees that I'm getting. It is part of my P&L. It is part of my book. I cannot simply switch this off and start something all over again. And that is, of course, what fintechs can do, and that's why they're so successful. So yeah, for banks, it is that it is not simply like switch the button, right? And I see I'm very active at Rack Bank within the digital space, and not only on the wealth side. And of course, you push boundaries because yeah, in the short term you need to keep going, right? And so consolidation will certainly be there. It's inevitable if you see how banks are reacting. Within the fintech space, yeah, well, of course, a lot of initiatives are taken, right? And a lot of people feel like, okay, now I'm an entrepreneur, I'm going to start this. But again, you will only have a few that will be successful and grow. I mean, that is with every initiative, that's with every kind of a business. And that, of course, will also happen within the Robo advice fintech space.
Let me get a couple of questions out there. Sorry, Mehdi, just because of time, which is kind of brings us back to the start, this question. So what do you guys think of the recent surge in retail investing? Is that sustainable or short-lived trend? And I'll add something to it. You know, is that an opportunity for a Robo or for a bank's wealth management team, or a threat?
So I think there are parts of it that will remain. So the idea that more people are taking ownership of their own financial future and they want to have a say in kind of how they invest, I think that part of it will remain. I think part of it, in particular, some of the frenzy on kind of a free brokerages, I think that's particularly pronounced in the US with, famous Robinhood, some of the famous stories. I think part of it will probably not stay for the very long term because, as I think Mehdi was mentioning earlier, the market doesn't always go up, and so there will be, I think, some shocks on the way up and down in the foreseeable future. In general, to your final question, I think it's an opportunity for the industry, being a digital player, being a bank, to help clients make more sense of how the money works for them through a variety of different services. And you'll have people that are more self-directed, and so they want more of the Robinhood model, people that actually believe that the type of sophistication that an advisor can enable is difficult to get by yourself. And I think you're going to have a little bit of both over time.
Yes, and to add to what Michele said, let's just rewind a bit, 2018-19, when Bitcoin was only a play for the retail, for individuals. When the price reached $20,000, everybody was bubbling into it, was pumping savings and taking punts in it. And when the bubble deflated, we fell down as low as $3,000, and then for several months, I would think even more than a year, you had almost no price action, very low volumes. Bubble has died. And it's only now that is playing again that more retail players are go there. So yes, indeed, when when it is the high tide, any boat will float and any boat will go high. And when you will have the low tide, this is where things get more complicated, and probably a lot of retail people could lose some of their investments, would forgo some of the profit that they thought they had, and indeed they might turn back to more professional or to more assisted ways of investing their money.
Great. Fred, I'll let you have the last word on the subject.
Well, since the digital, and we started with like the computer in your pocket, since we have that computer in our pocket, we don't want anything standardized anymore, right? We want to stay in full control. We want to have it everywhere and every time, right? So anytime, sorry. We want to decide ourselves if we want to go digital or we want to call somebody. So yeah, we want to do it ourselves, right? And that is what Amazon learned us, and it has to be in one click because we don't like 3 clicks anymore. But at the other hand, yeah, that trend is there. The trend is very positive. But of course, we will have these hiccups. Like for instance, 10 years ago, 12 years ago, when we said, yeah, online banks, yeah, let's put our money in online banks, and you put your money in counting, and all of a sudden it was gone, and everybody was saying, where is my money, right? So that kind of accidents will also happen, and only shape that process and make robo advice as a concept more robust over time.
Guys, we've well and truly run out of time. In fact, we've overrun. So I'm going to say thank you so much for your thoughts. Really interesting. I think there's a lot of material that we've covered. I hope the audience found it interesting. Many questions we didn't get to, but I think this subject will be continued to be debated, and it is for sure being disrupted and very exciting. And on that note, I'd like to hand back to Zach.
I'm always so impressed with the amount of engagement that we have from the audience on these sessions. Clearly such an interesting subject, and to be moderated by none other than the team at Saxo Bank, who have really been at the forefront of, before fintech was a term, Saxo Bank was a fintech and was thinking of technology first in the banking and financial services industry. Please be sure to join us next week on April 5th at 4 p.m. GST. We're going to be talking about the next generation infrastructure in the asset management industry. This session is being sponsored by Abu Dhabi Catalyst Partners, a joint venture between Mubadala and Falcon Edge Capital, which has been making some very interesting investments into this space. If you are joining us on YouTube, please like this video and subscribe to our YouTube channel now. Looking forward to seeing you again in the future on the next AIM Summit webinar. Thank you again so much.